From New York City, for our viewers worldwide, I'm Katie Greifeld. Futures higher right now with traders focus on the data rather than the debate. The countdown to the open starts right now. Coming up, President Biden's debate performance creating more questions than answers about the future of the election. Futures, though, on the rise as the latest PCE data shows slowing inflation, supporting the case for a rate cut, and Nike heading for its worst drop in 4 years after missing Wall Street's expectations. We begin with the big issue, the latest inflation data supporting the case for lower rates this year.
On the whole, the economy is slowing. And let's remember, this is an economy that has very few buffers. Most of the buffers that we've had in terms of personal savings and in terms of debt capacity, they've been run down. And that leads you to the second question, which is a forward-looking Fed would certainly have the possibility of a July cut on the table.
Joining us now, I'm thrilled to say we have Steve Wieting. He is Citi Global Wealth Chief Investment Strategist and Chief Economist, joining me on set. Great to see you in person.
Thank you.
So it's always a delicate dance one has to do when the big topic of conversation isn't what's driving markets. And I'm, of course, talking about politics. So let's just start right there, because I have this stat that the S&P 500, it's risen in 13 of the past 15 election years and posted double-digit annualized returns in both the Trump and the Biden administration. So is there any reason to think that this go-around would be different?
Well, that's the real thing. Regardless of who was in office, I mean, under Trump, there were 16% returns. Under Biden, 12% returns. Well, why? The economy was in recession 2 months out of the last 8 years. In reality, again, we have a tech-centered growing economy, and that's been the case, under either. All years since World War II, 74% of years have had positive returns for U.S. stocks. And the economy has only had about 15% of all months in recession. I mean, that's what's really critical here. Is there going to be something on the policy front that's going to drive a turning point for the economy? It will matter for certain industries. It's going to matter for foreign policy in countries, but it is not critical to the direction of the economy. If it is, we've got a problem.
So it sounds like what you're saying is there's not necessarily a Trump trade or a Biden trade to put on here, that you would look past that.
Ones that are not discounted by markets in advance. Now, that's careful. There'll be some reaction. Let's just remember that every election around the world this year has generated some sort of surprise, whether it's India or Mexico or France. Again, the composition of Congress. This is not something that we're going to ignore all the rest of what we have now to speculate on the composition of Congress post-November.
And we did get some data this morning, of course, at 8:30, not too long ago. So let's get to that PCE print just out right now. We're going to go to Michael McKee. He is Bloomberg Chief Economist and Policy Correspondent. What did we learn at 8:30?
Well, we learned things are getting better. I mean, it was a good news report for the Fed, for consumers, for the folks at 1600 Pennsylvania Avenue. Kind of won't overwhelm last night, but inflation is going down, spending's hanging in there, and Americans are making a lot more money. That's the bottom line. The headline PCE number comes in flat, and the PCE core comes in up just a tenth. Now, if you look at those, and Steve was asking me before we came on here what the unrounded numbers were, the headline unrounded number was negative, 0.01 negative, and the headline core was 0.08. So we definitely had inflation kind of disappear during the month of May. Spending up 0.2, incomes up 0.5, and here's the interesting thing. 0.7 of that was of the wage component was up 0.7 on the month, the strongest in several months, and it shows that wage pressures might still be out there, but they don't seem to be hitting inflation yet. And we know from experience that people spend what they have. Now, if you don't have the ECAN function on Bloomberg, call Katie on her personal cell phone at 8 o'clock on Saturday night. She'll get it for you. But take a look at what the breakdown is here in terms of the where the impacts were. And you see that basically it was in the services area, we're still seeing inflation only up 0.1% during the month. Goods, which are the purple thing there, they're still deflating. They're going down in price. They were down by 0.1%. And we're looking at energy and other aspects of it making up the difference. But it basically shows broad drop in the overall inflation pressures. And then we want to talk about, again, the wages thing. And I have a chart here that basically shows the difference between wages and inflation this month. Go all the way over to the right. You can barely see inflation, and look at the bar for wages. Maybe too late for Joe Biden. The political analysts can debate that, but certainly the case that people are doing better versus inflation is made by this PCE report. At least they were in May. Put it that way, Katie.
Yeah, it's definitely a difficult message to communicate to voters, which we did see last night. Michael McKee, thank you so much. And let's turn back to Steve now. So the unrounded PCE number, is that how specific we need to be right now?
Well, it's just this worry that if, we were, 0.16 instead of 0.14, you have a whole different story here. I mean, the reality is that this is sample-based economic data. There's a great deal of subjectivity to these different inflation measures, which can tell different stories. The reality is we're down from the 7% average inflation rate of the last 2 years. And if you want to know why people are unhappy, well, they're not getting their old purchasing power back. We're not deflating price levels back to where we were pre-pandemic, and that was never a reasonable prospect. Central banks have never done that. So even if inflation is rising much less, there's still a concern about what you can afford. And that's not going to go away quickly. This is the sort of thing that, you remember older people would tell you about the days when inflation galloped higher. They're not thinking about the disinflation that came afterwards. But still, overall, we're in a good performance for the economy globally. Supply and demand are meeting at more stable price levels. I do think, and I was listening to the earlier debate, that monetary policy on a forward-looking basis is going to restrain the economy. It's particularly the growth rate of employment that the Federal Reserve will turn to. The last couple of years, raging strong gains in employment. We've now lost 4 million unfilled job openings. The pace of employment compared to the initial recovery, as it should be expected, less than half the employment pace. So going forward, is tight monetary policy and this inflation rate really the right combination? I think, again, ideally, the Federal Reserve would back off of this and not take risks to the downside with the economy, protect the recovery.
Protect the recovery there. And I mean, where does that leave you when you take that conversation to the markets? Because right now, I mean, over the past several years, it seems like the playbook has just been technology. Avoid the smaller areas of the market and you'll probably be okay. Does that change?
Well, look, I mean, how good we can do when a single stock drives 30% of the market gain and it's risen ninefold in 18 months, you might just say, well, there's a lot of good news on AI. I think that could plausibly continue, but you can't quite tell when that's a little bit overpriced. You can't quite be sure. Are you looking back at a Cisco Systems, or are you looking back at an Apple at circa 1999, that is going to go up or down over the long term? You can't know these things perfectly in advance. Innovation is very, very difficult to predict whether certain companies will be able to capitalize on their innovation or will face intense competition or emerging competition. So it's really not about cutting your exposure or all exposure by any means. What it's really about is just controlling your exposure and then thinking about the fact that we have enormous opportunities for smaller growing companies that are not indebted, that are trading below their long-term average valuation. Or thinking about the bond market where the yield environment, I mean, in many cases, these coupons are 10 times higher than they were in 2020.
Right. Well, let's talk a little bit about some of the underappreciated areas of the market that you might be looking to right now, those smaller companies with big growth potential. So those exist out there. It also seems like you could definitely fall into a lot of value traps right now. How are you making that decision? What does the due diligence process look like? So
for us, and this is not terribly easy in terms of asset allocation, it brings us somewhat closer to an active management style where we're overweighting thematic opportunities. Like I said, instead of buying the Russell 2000, has indebted companies, has some submerging companies, looking at mid-cap growth companies that are less leveraged. That is one opportunity. The other is, again, thematically by industry. You know, we've been overweight cybersecurity companies, for example. We think that there's a powerful spending trend long term, but there's also more intense competition of late, so we've backed off of that. We think that parts of the healthcare sector, you know, have been steamrolled by GLP-1 drugs, right? So there are areas of the healthcare sector that have really strong, enduring defensive growth characteristics that have underperformed by a record amount. So these are things that we're doing thematically. Now, again, to avoid the value traps, we would probably throw less at just a regional market, right? Small caps in Europe, we're just, you know, not adding a lot to
Small
regions.
caps in Europe. I haven't heard anyone recommend that, I have to say.
Well, like I said, it's not an area, it's an area we're underweight.
Yeah, and I want to focus in on one thing you mentioned, and that's leverage, because it feels like you really have to take a microscope to this market to find the effect of higher rates. We've just barreled to these new record highs on the benchmarks. But when it comes to those heavily indebted companies, it sounds like that's definitely across sectors something you would want to avoid right now.
Well, look, in some cases, it's priced quite differently across market segments. In the high yield bond market, credit spreads are tight. In the high yield loan market, credit spreads are wide, historically wide. In fact, in the loan market, the levels of interest rates, 9.7% as a sort of just gross nominal yield, is the highest since the global financial crisis. And if you take a look at the fact that the U.S. Treasury yield curve is inverted, we have this deep expectation of policy easing by the Fed, tight credit spreads throughout the corporate bond market. One thing that seems to be there is the expectation that adjustable rate fixed income securities will have a big cut in their yield, right? So it's left us an opportunity, I think, within this segment. It's the reason why we've just raised to a small position in the highest risk component of our bond portfolios. We've added loans.
And let's end on the fixed income market specifically, because it's a simple question, but it's one of the most enduring. And I mean, you just walked through the different opportunities that you're seeing right now, but why do anything but cash at 5%? No credit risk, no duration risk. It seems like a slam dunk.
Well, again, we're not arguing that you should take long duration risk, right? And just say there's going to be even more Fed easing than is priced in. Now, that's a possibility, and you'll know it if you're a long bond investor and that happens. But the key issue here is that the Fed expects its long-run policy rate to be 2.8%. It expects its policy rate to be 3.1% in a little over 2 years, right? And so you can lock in yield now, build a portfolio in excess of 6% yield with a 4 to 5 year duration. If you take, again, you have treasuries as a big component, you have high-grade securities as a big component, and you take a couple of additional steps in your bond portfolio. That way you can have these kinds of yields in cash for much longer than the Fed is likely to be there.
Well, Steve, it's always great to see you. Really appreciate you taking the time on a Friday morning. Our thanks, of course, to Steve Wieting of Citi Global Wealth. And joining us now with a look at the stocks moving ahead of the opening bell, let's get to Abigail Doolittle. Well, the one stock that everybody's truly watching, Katie, the shares of Nike absolutely plunging, heading to the worst day in years. The current decline of 15.7%. Well, that is worse than the sell-offs that we saw in March of 2020. They, of course, missed sales by about 2% in the quarter that was. For the fiscal first quarter, this current quarter, the sales view is light. Their casual and lifestyle segment was an issue before, needing a new product refresh to compete with some of the other running shoes. In addition, Raymond James, JP Morgan, Stifel, UBS, Morgan Stanley all cut this stock from the equivalent of a buy to a neutral. Really a show me story. As for some other stocks moving on the day, the shares of Trump Media on that debate debacle for President Biden, well, they are up about 10%, up 11% at this point, up 40% into the debate yesterday, heading to the best week since late March. Morgan Stanley higher by about 0.8% after PCE, even after yields down. We have some of the banks higher. And then finally, Apple up about 0.8%. We put out a story earlier today, Katie, as you know, that the China iPhone shipments popped by 40% following solid discounts. That stock now really stuck in an interesting place before it potentially breaks out in a big way or falls right back down into the range. Yeah, we'll have to see how that one shakes out. Abigail, thank you. Now coming up, Biden and Trump trade barbs in the first presidential debate.
We're working to bring down the price around the kitchen table, and that's what we're going to get done.
He inherited almost no inflation, and it stayed that way for 14 months, and then it blew up under his leadership.
More on the fallout from last night's debate next. This is Bloomberg.
We've brought down the price of prescription drugs, which is a major issue for many people. We're working to bring down the price of around the kitchen table, and that's what we're going to get done.
He has not done a good job. He's done a poor job, and inflation's killing our country. It is absolutely killing us. He inherited almost no inflation, and it stayed that way for 14 months, and then it blew up under his leadership.
Well, round one is over. President Joe Biden and Republican challenger Donald Trump squaring off in the first presidential debate in Atlanta. Now, that performance from President Biden raising questions about the future of his campaign. Joining us now is Bloomberg's David Gure, joining us from the ground in Atlanta. It's the morning after. We're not talking about substance. We're talking about age. And the consensus seems to be that President Biden showed his age last night.
Yeah, we'll see if there's going to be a round two. I think there's many days before we get to that point. That next debate scheduled to take place in September. But you're right. I mean, we were looking for sort of flashes of substance over the course of that hour and a half long debate. But almost immediately it was clear that style was going to rule the day. From the get-go, Joe Biden came onto the stage, mumbling, dealing with a sore throat or a cold, according to his campaign, and just looked completely mismatched with his opponent, the former president of the United States. And we heard just a moment ago some of the conversation on inflation and the economy. Obviously, some untruths there in what the former president said, but over and over again, faced with that, President Biden didn't fight back, didn't fact check him in real time. So I think it was a surprise to many of us watching for many reasons. One of which was we know that the president spent several days at Camp David in isolation with his policy advisors, preparing for this debate, going over policy papers and all of these points, and presumably preparing retorts, ways that he could get under the former president's skin. And none of that really was on display, Katie, during the course of that debate.
And I mean, you can see the betting markets obviously moving quite dramatically in the aftermath. I mean, what has the messaging from the administration been in the aftermath of last night?
Publicly, it's been that this is fine. He had an off night. As I said, they're saying that he had a cold. And after this debate, he went to a Waffle House in Atlanta, got an early breakfast before he took a flight to Raleigh, North Carolina. Seemed a bit better, actually, in that forum than he did on the debate stage. But I'm not sure that that's going to provide much comfort to skeptics or those who are whispering about his capacity to serve a second term, that a cold could take him out in this way and he would be rendered so unable to perform on the same level as Donald Trump on that debate stage. But the White House is putting forward a very positive spin on all of this they're trying to do. But there was a kind of interesting moment on the heels of this debate. The media watched it in a basketball arena at Georgia Tech. We were seated around the concourse. And then afterward, we went to the floor of that arena, and surrogates for both of the candidates were supposed to come out and spin the debate in the best way possible. Well, there were a ton of surrogates for Donald Trump who came out almost immediately from each entrance, it seemed like, to that arena. It took about 10 or 15 minutes, Katie, before we got two surrogates for Joe Biden. We had Governor Gavin Newsom of California and Senator Raphael Warnock of Georgia, who finally came out, kind of stood near each other and were surrounded by reporters. But one got the sense that they were spending those 10 or 15 minutes trying to figure out what, if in any way, they could spend this positively.
Well, give us a sense of the atmosphere on the ground. I mean, how did the temperature in the room change from before the debate to after the debate?
So as I said, I was sitting watching it on the Jumbotron in this arena, and the debate got underway, and there was kind of even a halting greeting by Joe Biden at the beginning of this, and a lot of us looked up kind of out of surprise. They didn't shake hands, obviously, but it was evident early on that this was not a strong performance by the incumbent president. And then after it ended, there was this kind of period of quiet before people made their way down to the floor, and then you had to listen to what these surrogates were saying. Yes, on the Republican side, then on the Democratic side, and then they were pumping cable news into the arena so you could hear sort of how the pundits on CNN chiefly were discussing this. And I think what's interesting is you saw a lot of establishment Democrats who were talking about Joe Biden's fitness for office and this concern unabashedly in a way that they hadn't before. So this kind of opened the door to that. And I think that was what was immediately evident to me, is how the conversation changed almost immediately, that what were whispers became much louder after the course of this debate.
And of course, we're spending a lot of time talking about President Biden's performance. Of course, that is the focus of most of the conversations this morning. But how was Donald Trump's performance on its own?
I mean, he seemed confident. We were talking yesterday, you and I, just about the weirdness of this format. There wasn't going to be an audience. How was Donald Trump chiefly going to do, not having that audience to feed off of? And it was actually quite surprising to me how well he did in that format. Of course, each candidate had 2 minutes to respond to questions, and there were many moments when Joe Biden would exceed that and his microphone would be muted. That didn't happen with Donald Trump, and he had a seemingly greater control of the format. He wouldn't always answer the question, There were a lot of lies and mistruths, but he very effectively used that time, I think probably to the frustration of those who wanted more substance. He had things that he was hitting on. But going back to what I said at the top, just about preparing for this presentation, Donald Trump clearly had 3 or 4 things he really wanted to hit on, chief among them the economy, immigration, fear about crime. He kept coming back to those things and getting them into this conversation. Again, not necessarily answering the questions that were posed by the moderators, but making it very clear that these were sort of central tenets of the platform that he has as he runs for president for a second term.
And David, I know you haven't slept, so I'll let you go. But in just 20 seconds or so, is there going to be a second debate?
I think that's a very open question. I think these next 48, 72 hours are going to be really pivotal. That debate's scheduled to be on September the 10th, so we have 2 conventions before then, and I think the shroud of uncertainty is now being cast over that Democratic convention. What's going to happen there? What's going to happen in the run-up to that? I don't think anybody is feeling very confident betting that we'll see that second debate in September, although it is on the calendar.
All right, David Gure, great reporting. David Gure, of course, is the host of the Bloomberg Big Take podcast, joining us live from Atlanta. Now, coming up next, the morning calls, and later, HSBC's head of equity strategy Americas on why she's expecting more volatility in the second half of the year. This is Bloomberg. All right, it's time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. And first up, UBS cutting Nike to neutral after the company's outlook fell short of expectations. The analyst there writing that Nike's fundamentals are, quote, much worse than we realized. Now, that UBS call follows a number of analysts downgrading Nike and shares absolutely plunging pre-market. Next up, Seaport Global raising its recommendation on International Paper to a buy. The firm sees positive trends after the Brazilian company Suzano said it would end its pursuit of the U.S. paper giant. And finally, we do have Raymond James initiating Deere as an outperform. The firm says it's bullish on the ag equipment company, citing its leadership position and technology investment. And those, of course, are some of our morning calls. Let's take a look at markets right now, just moments away from the start of U.S. trading on the last day of the first half of the year. You can see S&P 500 futures a little bit higher right now, about 0.1%. You take a look at big tech, that NASDAQ 100 a little bit higher than that, up about 0.2%. And small caps actually are your big leader today. You can see the Russell 2000 up about 0.9% in the pre-market. Of course, we've got some good news on the inflation front this morning. Now, coming up, Nicole Inui. She is HSBC head of equity strategy Americas. She will be joining us for the second half of the year outlook. This is Bloomberg. This is the countdown to the open. I'm Katie Greifeld. We are moments away from the start of trading, and you take a look at the stock market right now as the bell rings. You can see the S&P 500 looking at slight gains here. Same too if you take a look at big tech, but it's the small caps that are having their moment in the sun. The Russell 2000 currently up about 0.8%. Let's also take a look at the cross-asset picture as well. You're seeing a little bit of euro weakness right now. That euro-USD pair, of course, hanging out around 106, 107, thereabouts. Take a look at the bond market, though. You are seeing a rally after those PCE numbers this morning. That 10-year yield, it's only down about 2 basis points, but it was higher going into the print. So a bit of a reversal there. And crude as well, having a little bit of a rally right now, up about 0.2%. Let's go back to the stock market, though, because one stock to watch at the open, of course, is Nike. It's heading for its worst drop in 4 years after sales missed expectations. Bloomberg's Abigail Doolittle joins us now with more.
Well, the selling has increased to such a degree, Katie. We're now looking at the worst day for Nike since 2001, down about 17%. Moments ago, down closer to 19%. And this, of course, as that guidance for the full fiscal year, disappointing investors. Folks had been expecting growth of about 2%. Now they're saying it's going to be a mid-single-digit decline. So depending where that shakes out, that could almost be a 10% miss in terms of sales on not small numbers. It's really pretty significant. On the quarter that was, we saw a preview of this with the company missing sales by about 2%. Their lifestyle brand, Converse, disappointing. But of course, it's the iconic running sneakers. Lots of competition coming from the likes of Adidas, Hoka, and others. Investors and analysts really wanting to see what product can they put up. There's been some hope around the Paris Olympics. Not a lot of talk about that at this point. More talk about the idea that this turnaround story is going to take a long time. To that point, we now have the stock down more than 50% from its 2021 pandemic peak, and relative to analysts, Raymond James, JP Morgan, Stifel, UBS, Morgan Stanley, there may be others, all cutting the stock from the equivalent of a buy to a neutral. Nike now clearly a show me story, and again, the worst day since 2001.
Yeah, and a really tough reaction from Wall Street, to your point. Abigail Doolittle, thank you for that. Let's get to some good news. We have Apple higher a little bit after iPhone shipments in China rose 40%. Bloomberg Technology co-host Ed Ludlow joins us now with more. And this, of course, is one of the big worries that's been weighing on Apple this year.
Yeah, it's a continuation of an interesting recovery. So Bloomberg's kind of done the math using official data out of China, which is issued by the Academy of Information and Communications Technology. It's a 40% year-on-year gain in iPhone shipments in the month of May. We had a 50% year-on-year gain in the prior month, so a slight month-on-month deceleration. The point is that Apple had a really tough first quarter, January through March, where sales not only kind of were down, but you saw domestic handset makers gain market share. Then we entered kind of a heavy period of discounting. And that June sales season seems to be going well for Apple as it stands. There are a number of sort of onshore e-commerce events and domestic discounting events. So it's showing some stabilization. I find the stock really interesting as well. We're up 0.8%, a fifth straight day of gains. That's the best run since an 8-day winning streak ended on June 8th. And it's amazing how quickly the narrative changes. I think Microsoft's down modestly, a few tenths of a percent. But, you know, before you know it, Apple might be the world's most valuable company again. And now that the AI story is playing out and you think about valuation, where Apple trades in terms of price to earnings, people are starting to sort of pay notice again. So whether the recovery continues, this is just 1 month's worth of data, but it is a continuation of a trend we've seen, at least going back to last month, where the Chinese market's starting to improve for them.
Yeah, I mean, you're right, Ed. Slowly but surely, Apple has been stringing together these gains, currently up about 12% for the year. It wasn't too long ago it was negative for 2024, so I'm sure you'll continue to follow that one closely. That, of course, is Ed Ludlow. Let's turn now to Webtoon. It's climbing after the online comics company made its U.S. IPO yesterday. Joining us now with more is Bloomberg's Natalia Konijevic.
Katie, so the stock is up by 7%. It gained 9% yesterday. The company raised $300 million. It sold 15 million shares, and it brings its market value to about $3 billion. The company is saying that it plans to use those proceeds to expand business globally. But we have to say that this company is already considered to be one of the most successful cultural exports from South Korea. Basically, Webtoon, it's a digital comic platform. It has thousands of stories across different themes like romance, comedy, etc. And they are sliced into small episodes, and users typically read them on their smartphones. It has a pretty wide network of users. It connects 24 million of creators with about 170 millions of users. And Katie, the average age is under 25 years old, so it's a pretty big network of users, but it's a pretty narrow at the same time age category. So this definitely not us.
And even still, I mean, a warm embrace by Wall Street. Shares up about 11%. Bloomberg's Natalia Konijevic, thank you so much. And we've gone about 10 minutes without talking about politics, so let's get back there now, because shares of Trump media, they're jumping following the former president's debate performance last night. And let's get to Bloomberg's Simone Foxman with more.
Yeah, Katie, it's actually been a pretty wild trading session so far for shares of Trump media. They were up as much as 9% in the pre-market. Then they fell to about 2%. We're now looking at gains of about 3%. All of this, of course, on the back of Biden's rather stumbling performance in the debate last night. I would say that Trump himself cited some inaccuracies, made some exaggerations, but looked far more vigorous than his opponent in that debate. And of course, we've seen those calls signals proliferating for Biden to step aside across even left-leaning commentators. I will say the swing is not particularly strange for Trump media. Shares, for what it's worth, were up about 20% on Monday, even despite the SEC approving last week of investors in warrants, allowing them to swap them for shares, something that could dilute investors. But on this, Trump theme and enthusiasm for all things Trump, I should note that WiseSoft, a Chinese company in trading there, its name sounds like Trump wins big to Mandarin speakers, and shares were up 10%. So no surprise that we're seeing Trump media rally as well.
Yeah, there you go, up about 4% when it comes to DJT. Simone Foxman, thank you so much. And let's turn back to the markets right now, the broader equity markets, and what the second half of the year holds. Because joining us now, we have Nicole Inui. She is HSBC Head of Equity Strategy for the Americas. And Nicole, I want to start with your year-end forecast for the S&P 500, 5,400. You take a look at the S&P 500 right now, we're just below 5,500. What's going to happen in the next 6 months?
Great. Thank you for having me on. So I think, first of all, we have to think about the first half of the year. We've had a very nice first half of the year. You look at the S&P, it's kind of had this straight line going up over the past 6 months, a couple little hiccups, but really it's been a straight line moving higher. I think on the second half of the year, we see a little bit more bumps on the road. So I think we're going to see a little bit more volatility. Why is this? First of all, let's look at earnings. So earnings expectations for the second half of the year are elevated. So consensus is expecting double-digit earnings growth. So the bar to beat now gets much higher than what we saw at the beginning of the year. Also, GDP expectations have moved significantly higher. So we're actually now seeing activity surprise on the downside. So again, a little bit harder to get those expectations higher. And then, we have the volatility of the elections in the second half of the year. So I think, we're not ready to move our target yet. We really need to see earnings come in better than expected, get a little bit more comfort on that. And I think the second half of the year, it's going to be a little bit more bumpier than what we saw in the first half of the year.
Well, we're definitely going to get to the election, but I want to talk about what you said about earnings and, of course, expectations for the economy. It sounds like what you're saying is basically that too much good news is priced in right now and expectations are too rosy.
Mm-hmm. Well, it's, if you look at where it's obviously the S&P is above our target right now, and our target was factoring in what we see in terms of earnings growth for this year, which is 11% earnings growth. So, for the S&P to move higher, we need to see one of two things, or we need to see earnings expectations coming in better than expected. And again, we could see this, if we look in the second half of the year, where are we seeing the acceleration in earnings growth is really in the tech X Mag 7 stock. So it's the rest of the index. Earnings growth expectations are very high. And we're actually seeing, in terms of the Mag 7 stocks, you're going to see an earnings deceleration. This is really because you have a very hard comp base compared to last year. But if we see this acceleration, especially if you look in the Mag 7 tech stocks come in better than expected, that can actually support earnings growth even higher. But that's something that we really need to see in order to get comfortable in terms of moving our target higher for the end of the year. And obviously we have the Fed and the number of rate cuts. We're only expecting one rate cut in September.
One rate cut in September. And I mean, with that being said, that one rate cut, is that enough to really sort of put the momentum back into small caps, back into those smaller parts of the market that specifically aren't just big tech?
Great question. We don't think so. So we're very positive the S&P. I think for the small caps to outperform, you need to see a series of rate cuts. So we're expecting one rate cut in September, and then the Fed to pause, and then have 3 gradual rate cuts in 2025. Why is that? If you look at inflation, we expect inflation to come down enough for the Fed to be comfortable to cut in September. But because of base effects, we're expecting inflation to look a little bit higher going into year end. So I think when we have the Fed cutting rates in September, obviously there'll be a very nice catalyst for the equity market. But I think the narrative is going to shift from not when and if the Fed will cut, but how much. So if we get just one cut and then a pause, I think the question is going to be, well, how far can rates really go down? And for the smaller cap stocks to rally, we really need to see a longer runway for rate cuts than what we're seeing currently.
So that's one of the known unknowns, right? Of course, what the Fed actually does, how many rate cuts does it actually deliver? The other known unknown, which you already highlighted, of course, is the presidential election that is quickly approaching in November. We saw the first debate last night, and the flash polls would suggest that the perception among the public is that Donald Trump won that debate. But I want to give you a stat that I gave to Steve Wieting at the top of this hour, and that's that the S&P 500 has risen in 13 of the past 15 election years. So is there any reason to think that this year would be different no matter who wins?
Great question. So, for the elections, what we usually see is the volatility picks up really very close to the election. So, usually you see the S&P October and November in election years. That's when you see the volatility really picking up. So, and that's when the market really starts to pay attention to the elections. In terms of the performance, what we've seen historically is normally after an election, the S&P does increase going in from the election into year end. And what we see in terms of who wins and how that works, usually if you have a Democrat president and a split Congress, you do see a better performance in the S&P, or if you have a Republican clean sweep, that's usually the second best performance historically for the S&P. So I'm not going to go into politics, but I think what we've seen historically is usually the S&P does perform well following an election.
All right, Nicole, appreciate that context. Great to speak with you again. Hope to do it again soon. That, of course, is Nicole Inui of HSBC. Now, coming up, Biden and Trump face off.
We created 15,000 new jobs. We brought out a position where we have 800,000 new manufacturing jobs, but there's more to be done. There's more to be done.
The only jobs he created are for illegal immigrants and bounce back jobs, a bounce back from the COVID. He has not done a good job. He's done a poor job.
More on last night's debate as Democrats hit the panic button next. This is Bloomberg.
Making sure that we continue to strengthen our healthcare system, making sure that we're able to make every single solitary person eligible for what I've been able to do with the COVID. With dealing with everything we have to do with. Look, if we finally beat Medicare.
And President Biden's performance at last night's debate is sounding alarm bells throughout the Democratic Party. And joining us now with more is Annmarie Hordern. She is our chief political correspondent and co-host of Bloomberg Surveillance. So in the aftermath, what are the Democrats saying publicly? What are they saying privately? And how different are those two things?
So that gap is closing. In the past 24 hours, it's really a narrow gap of what they're willing to say out loud and what they're willing to say behind the scenes. There's been whispers about these concerns that we see reflected in the polls of the American electorate, that they just think Joe Biden is too old at 81 years old to do another 4 years. And then given his debate performance, how he was looking, how he was talking, a sore voice, coughing, very, very soft as well in his intonations, not really fighting back on Trump. They are literally hitting the panic button. And openly, you hear people talking about the fact that they might have to look for someone else. But this timeline, Libby Cantrell of PIMCO was on earlier, she's basically saying that they have almost 2 weeks to do this. The DNC is in August, the Democratic National Convention, and Biden has already shored up all the votes for that. So really, if he were to step aside and these calls were growing, and this is a Biden camp decision now, really, he would almost need to do what Lyndon Johnson did and make an Oval Office speech or make a speech and say, I'm going to step aside. Then, of course, there's another whole host of issues, which is who would fill that vacuum. This is what Terry Haynes was talking about earlier. He says he thinks that brings up too many other potential issues that it's very unlikely that Biden would step aside.
Well, we're going to get to the list of who it could be if it wasn't Biden, but you talked about that timeline and how tight it is, and of course the complications that would come along with that. I mean, how likely are people saying that, he actually could step aside here and not run?
It's really two different views. There's the one that's Terry Haynes that says it's very unlikely that can happen. And then Greg Valliere, who also talks to people in the markets and really tries to digest Washington for them, he had this out to say in his note. He says his bottom line is that Biden will drop out within days, giving an opportunity to a young, fresh face. So Biden camp today is going to be North Carolina, and then they're going to be in New York. He is going to be so closely watched, who he's meeting with, who he's talking to, who shows up to these fundraisers, and potentially if any of this has broken through to him and his camp. Because last night, what he told reporters was, of course I'm running.
Of course I'm running. That, of course, is the message coming out from the Biden camp specifically. But, I mean, let's talk about who some of those new, fresh faces could be. It seems like California Governor Gavin Newsom, for example, his name has been bandied about quite frequently.
So the first obvious choice is the vice president, Kamala Harris. And she came out last night and she even said Biden, it was a slow start at the start of the debate, but felt like many people in the Biden world, felt like he did try to pick it up at the end, even though for the most part, people felt like many Democrats are, you can look at some of the text messages, felt like this was a disaster. Gavin Newsom is interesting because he continuously comes up as someone potentially that has these presidential ambitions. He always says he doesn't. He's always there supporting the president. But if you look at the video of when the debate ended and the press that swarmed him, asking him, are you going to be the nominee now? It was almost instantaneous. Other governors, potentially, Governor Gretchen Whitmer, Governor Pritzker, Shapiro from Pennsylvania, there are names that are being floated, but again, whole host of issues, not just logistically, but also what does this mean for the party? Because there is an heir apparent, technically, with the vice president.
That's very true, of course, that those conversations also center around her as well. But we're talking about, of course, Democrats hitting the panic button, what that camp is doing this morning. Let's talk about the Republican side of things, because I have to imagine they're taking a victory lap right now.
They are taking a victory lap. They feel like in the flash polling, if you look at Frank Luntz and the focus group he had after the debate, it felt like people thought Trump won that. But also, when you look at some of the issues that came up and how Trump talked about them, there was a lot of issues that were riddled with lies, exaggerations. And did he do enough to secure the independents? Did either of them really do enough to secure the independents? So if you're walking away and you're unsure about either of these candidates, did Trump say enough, say on things like abortion? And if you're a suburban woman, did he say enough to make you feel, if that's one of your number one voting issues on reproductive rights, did he say enough to assuage some of your concerns? So I'm not sure people that are looking at this and looking at the narrow amount of individuals who are going to decide this election. We're talking about a few 10,000s basically in a few swing states. Did he say enough to assuage those concerns? Which is why for him, the VP pick is going to be so important. And today he's in Virginia, and stumping with him is going to be Governor Glenn Youngkin, someone who's on his list.
There you go. Definitely something to watch there. And just really quickly, I'll ask you the same question that I asked David Gure. Is there going to be a second debate?
Libby Cantrell says maybe there will not be. For Trump, why would you want a second debate? You want these clips of Joe Biden losing his train of thought to continue to circulate social media, continue to circulate TV networks until the election. If you're Joe Biden, you desperately want that second debate. Let's see. It's September.
Yeah, a lot can happen between now and then. Of course, Annmarie Hordern, really appreciate that reporting. And let's get to some of the sector price action this morning in the market. We're going to do that with Bloomberg's Abigail Doolittle.
We're looking at a small gain for the S&P 500 right now, Katie, up about 0.4%. More sectors are higher than not, so it is a broad-based gain. We have tech up the most, up about 0.75%. Some of that coming from the Apple strength on our own reporting about iPhones popping, the demand in China by about 40% after discounting. Industrials, energy also higher. To the downside, communication services, utilities, discretionary, and staples. So the day is still young, but the week right now we are looking at a fourth up week in a row. The S&P 500 up just a little less than 1%. Energy, the top sector on the week, up about 3%, in sympathy with oil, also up for a third week. And then it's interesting to note that the S&P 500 media and entertainment index, well, that's up about 2.7%. Of course, we have some of these networks doing well around the debate. Fox apparently had a big viewership spike during the Trump trial in May, but then, of course, also at the debate more recently for all these networks. And then take a look at that, Katie. The SOX down 0.4%, really standing out. That chip strength kind of ebbing away, now down for a second week in a row.
All right, Abigail, thank you so much. Coming up, the market-moving events you need to be watching. That's next. This is Bloomberg. All right, time now for the trading diary. What you need to be watching. We get Michigan consumer sentiment data at the top of the hour. Fed speak this afternoon. Monday, we'll watch the fallout from the first round of the French elections. Then on Thursday, U.S. markets close for Independence Day, and the U.K. It'll be holding its first national election in 5 years. But that does it for the countdown to the open. I'm Katie Greifeld, and this is Bloomberg.